So let's talk about one of the biggest, strangest paradoxes in all of finance. We're going to dive into why Warren Buffett, arguably the greatest stock picker who ever lived, tells almost everyone to do the complete opposite of what made him a legend. This is his blueprint for the rest of us.
Think about that. This is the actual instruction Buffett left for the person who's going to manage his wife's inheritance. It is shockingly simple, and it's the absolute core of what we're talking about today. So why? Why does the master investor tell you not to even play his game? The answer tells you so much about how markets and how we humans actually work.
So here's the game plan. First, we'll tackle the big paradox itself. Then, we'll get into the psychological traps that just trip up so many investors. After that, we'll look at the hidden power of low costs, the genius of betting on the whole economy, and finally, the ultimate proof, where Buffett literally puts his money where his mouth is.
All right, let's dive right into this central puzzle. I mean, it feels completely backward, doesn't it? The man who built a colossal fortune by finding these specific, undervalued needles in the market haystack is telling all of us, hey, forget the search, just buy the whole haystack.
This is the question we really need to answer. It's not that he thinks it's impossible to pick stocks. I mean, come on, he's living proof that it's not. The real reason is that he gets something fundamental about the average person and the way the market is actually structured.
And that is the key, right there. His advice isn't the easy way out, it's the strategic way out. Buffett knows that for most of us, trying to beat the market is a loser's game. And it's not because we're not smart enough. It's because the deck is stacked against us by two really powerful forces: our own emotions and the hidden cost of playing the game.
Which brings us to the first huge reason behind his advice: our own brains. Buffett knows that when it comes to your money, the single biggest obstacle standing between you and your financial goals is often, well, it's you. This is just a perfect picture of the emotional roller coaster, isn't it? When the market plummets, our gut reaction is pure fear. We sell to stop the bleeding, which just locks in our losses. Then, when things are soaring, that fear of missing out, that FOMO, kicks in hard, and we pile our money in right near the top. It's the perfect recipe for buying high and selling low over and over again.
And this is exactly where the index fund is, wow, it's just brilliant. It's a system designed to take your flawed human emotions right out of the equation. It's supposed to be boring. It just methodically buys the market day after day, week after week, no matter what the scary headlines or the crazy news is saying. It basically automates good behavior.
And this really gets to the heart of Buffett's whole philosophy. Trying to guess what the market's going to do next is a fool's errand. The real proven path to building wealth is just having the patience and the discipline to stay in the game through all the ups and downs for a very, very long time.
All right, let's switch gears to the second pillar of his argument. This has nothing to do with feelings and everything to do with cold, hard, brutal math. We're talking about the hidden game of costs, where tiny little fees can secretly destroy your returns over time.
So when you invest, you've basically got two choices. On one side, you have actively managed funds. These are run by super smart, highly paid people who are all trying to be the next Warren Buffett, and they charge you a lot for that effort. On the other side, you have index funds. Their goal isn't to beat the market, it's just to match it for a tiny fraction of the cost.
Now, 1 or 2%, that doesn't sound like a lot, right? You might think, hey, I'll gladly pay that if they can get me better returns. But here's the problem. First, most of them don't beat the market over the long run. And second, that fee just keeps coming year after year after year. But now look at this, the alternative. Less than 0.05%. The difference is just, it's staggering. We're talking about a cost that is 20, 30, even 40 times lower. This isn't some small detail. This is the entire game.
You know, we all hear about the magic of compound interest working for you. Well, high fees are the exact opposite. They're the nightmare of compound costs working against you, silently, year after year, just eating away at what should have been your money. Okay, so we've got psychology, we've got costs. The third piece of this puzzle is all about risk. It's about shifting your mindset away from that high-stakes gamble of picking the next big winner and instead embracing the incredible power of just owning the whole haystack.
I mean, think about it. Picking one stock is just so risky. Even the biggest, most dominant companies can get completely wiped out by a new invention or just plain bad decisions. Who back in the 90s would have ever guessed that giants like Kodak or Blockbuster would just disappear? Betting on one company is a huge gamble. But an S&P 500 index fund? That's a totally different kind of bet. You're not betting on one company to succeed.
You're betting on the collective genius, the hard work, and the long-term growth of the entire American economic engine. Sure, some companies will fail, but the system as a whole has always moved forward over time. You're betting on the whole forest, not just one tree.
So, we've gone through all the theory, but what about the proof? The real-world evidence. This is where Buffett's advice goes from just being smart to being pretty much undeniable.
This is great. Back in 2007, Buffett threw down a public challenge. He bet $1 million that over 10 years, a dead simple, low-cost S&P 500 index fund would absolutely crush the performance of a hand-picked portfolio of sophisticated, super expensive hedge funds. The whole financial world was watching.
So, who won? Well, it wasn't even a fair fight. The boring, cheap index fund completely trounced the funds chosen by the so-called smart money. And the main reason why? Those crazy high fees the hedge funds charged acted like an anchor, constantly dragging down the performance. It proved Buffett's point perfectly.
But look, if that bet was the public proof, this is the personal proof. And honestly, it's the most powerful argument of all. When it comes to the financial future of his own family, the person he cares about the most, he doesn't tell them to follow his legendary stock-picking strategy. He tells them to buy the simple, elegant, low-cost index fund.
So let's just boil this all down. What is Buffett's blueprint? It's actually just 3 simple steps. Number 1, own the market. Get a piece of everything with a diversified index fund. Number 2, pay low fees. Be absolutely relentless about keeping your costs as close to zero as you can. And number 3, and this is the hardest part, just stay invested for decades and let that miracle of compounding do all the heavy lifting for you.
And that really just leaves us with one final question for you to think about for your own financial journey. After hearing Buffett's logic, a logic built on psychology, on simple math, and on decades of proof, which game do you really want to play? Are you going to keep searching for that 1 in a million needle, or are you ready to just buy the whole haystack?